Hey guys, I can do this 7 stuff, but the videos I'm not good at. Okay, so let's start with a couple questions and see what I can do. Everyone can hear me okay, I think? And like I said, if you miss some of it and don't take notes, I am going to work on, I hope I don't yell. And if I'm tired, I'm sorry, I got home really late last night. That's kind of what I do. Okay, so I'm going to see what I can do. I'll go into a little bit on options. I see a couple put and call questions. I don't go heavy because I do have to earn a living. And if you want to come in and work with me, I can do that. So let me start with the first one, series bonds versus serial. A series bond is more like a series of bonds. So what we're going to do is we have a single issue date. Say you have a 10-year bond. And then we issue in 2018, we issue a 10-year bond. And then in 2019, we issue a 10-year bond. In 2020, we issue a 10-year bond. And that's a series. It's a series of bonds. A serial bond is more like what a lot of GOs do. They'll issue one bond on like 2018, and one will be a 10-year. Then there'll be an 11. Then there'll be a 12-year, and a 13, and a 14. So it all starts on one day. And it's a 10-year bond, 11, 12, 13, 14. The reason they do that is so they don't have to come up with all the money in one shot. I issue $1 million bond. In 10 years, 100,000 of it matures. In 11 years, 100,000. In 12 years, 100,000. So this way, we don't have to have all of it in one shot. So if I'm the GO or I'm the town, I don't have to come up with $1 million in 1 year. I can pay it off over a couple of years. Okay. Now, the next one, Caesar again, and I'll do that, and then I'll jump to the next one. What's the sense of buying bonds at a premium? So you have to understand it doesn't really matter where you buy them. So say we have a 5% bond here. It's at 1,000. We have a 5% bond. If interest rates in the economy go up to 6, what's going to happen to the price of my bond? It's going to go down. But what happens is the price of the bond goes down, and the yield of the bond goes up until it matches what's out there now. So it doesn't really matter. If you buy a discount bond, say you buy a 5% bond at 800, that's going to return, I don't even know what would that return. Let's see. Oh, you know what? I should ask you guys. What would a 5% bond trading at 800 be yielding? Current yield. No, not all. So if you buy it, you would have a loss if you bought it at par. So, well, it's 6.25%, right? So if I buy, if I do it right, you have a 5% bond. Current yield is coupon over market price. So it's $50 divided by 800, which is what you paid, would be 6.25. There's no shot you're reading that. Okay. So now, oh, I get it, Mike. So if you buy, the current yield is always coupon over market price. That'll definitely be on the test. Current yield. So if you buy a bond at 8, so say in our original example, you have a 5% bond trading at 1,000. Interest rates raised to 6.25 in the economy. The bond will drop to $800 so that the current yield or the yield that they're earning is still 6.25. So it doesn't matter. Whether you buy the par bond at 6.25 or the 5% bond at 500, you're still going to get 6.25. The other way is if the interest rates go down to 4%, the bond will go up in price until its yield is equal to 4%. So the purpose of buying your premium bond is there's no difference. The only issue you have is you may have some amortization, which is the next exam, not this one. So again, you buy a bond at a par or a coupon bond, interest rates go up, bonds go down, interest rates go down, bonds go up. Now the next question is, which ones move the most? That's always an easy question. Long-term bonds move the most. If you have a 30-year bond, a 10-year bond, 30-year bond will always move the most in price. The next filter is coupon. The lower the coupon, the more the bond will fluctuate. So if you have an 8% bond and a 4% bond, the 4% will always fluctuate. I can go into why, but it doesn't really matter yet. The next filter is discount bond. So if you have a premium, a par, and a discount bond, the discount bond will always move faster than par premium. Hope that helps a little bit. So let's go. Okay. Couple things. Again, Caesar said something about Past Perfect. I'm okay with Past Perfect. They're pretty solid, but as Tegan said, they are very math related, a little bit too much. Their math is a little too hard on you. It's pretty much, they try to confuse you a little bit, and their option questions are hard. Their margin questions are hard, almost too hard. So it's a little tough. I'm okay with them. Their word questions supposedly look a little bit more like the exam than the other ones, but then their math questions make you doubt that you could even pass the exam. So that's a problem. Okay. Now Tegan asked, opening sale, opening purchase, stuff like that. It's not so easy, but we'll do it. So if I buy a buy an option. See, it's late. I buy an option. Say I buy a 50 call at 3. I created a position. So by creating a position, that means you're opening your position. So buying what am I doing? Buying an option for the first time is an opening purchase. Now, if you open the door or open the position, how to get rid of it? You sell it by closing. So if you do an opening purchase of an option, see, I got it right this time. Opening purchase of an option, you would close the position by selling it. So you have an opening purchase followed by a closing sale. Now, if you see the word write an option, short an option, that means you sold for the first time, which means opening. Opening is always when you're creating a position. So if you sell for the first time, you're doing an opening sale. So then the next part is you would come back with a closing purchase. So always remember, opening purchase followed by closing sale, opening sale followed by closing purchase. Again, I'm trying to do a little quick just to get through a lot of these, but I think that should help you a little bit. Okay. Okay, so Joe, you said that, oh, again, so Tegan, again, about Past Perfect, don't sweat the equations. They are pretty hard. Like I tell you this, I'll get a 99 on the actual exam. I probably won't score above mid-80s on these exams because sometimes they're vague. Sometimes you don't know what they're looking at. It's just the way it is, okay? Okay. Joe, you said your test is on Friday, second attempt. Here's the thing. If you're using STC, you got to focus on chapter 14 through 18. I don't know in the other books what those chapters are. I'm just seeing it a lot. I mean, I can try to look it up and send out a message later. But while I'm talking, I'll see if I can find it. But a lot of stuff has to be, for the most part, you have to look. Regs is such a big part of this. Customer account, FINRA rules, MSRB rules. Those are a lot. So really focus on those. And don't worry about the math too much on this one. The top off is the one where you have to worry about more stuff. Okay. Okay, Anna. I'll do a quick thing on options. I can't do a lot, like I said. I do need to make some money, so okay. And I'll try to answer your question down there. A call is the right to buy. So it is a piece of paper. All it is a little thing that says Anna is allowed to buy 100 shares at $50. So it is. A call is the right to buy 100 shares at 50. If the stock goes to 60, you still have the right to buy it at 50. So you technically can make $10 minus the premium you paid for it. But here's the question. If you buy a call, a 50 call, and the stock's trading at 60 and you exercise, that means you get to buy stock at 50. Who's going to sell it to you? The only person that's going to sell it to you is the seller of the call, the person who has to. So always remember, there's two sides of the contract, the buyer of the call and the seller of the call. The buyer paid the money and he has the right to buy stock. The seller received the money and said, don't worry, if you want to buy it at 50, I'll sell it to you. That's what, so sellers have obligations, buyers have rights. Okay? Now, I think now a put is the same thing. A put is the right to sell. So Anna, you have the right to sell stock at 50 if you buy a 50 put. I'm keeping the premium out of it to make it easier. So if the stock goes below 50, you can still sell the stock at 50. So what you could do is buy the stock at 40 and you have a guaranteed sale at 50. But now, if the stock goes down to 40 and Anna gets to sell the stock at 50, who's going to buy it from her? The person who sold the put. So again, two sides of a contract. The buyer has the right to sell. It gets confusing. And then the seller must buy the stock when the buyer of the put tells her to. So the buy a 50 put means I have the right to sell at 50. The seller of the put must buy when I tell them to. So they have risk on that side. So buyer of a put has a right to sell. The seller of the put must buy. Keep in mind, buyers have rights, sellers have obligations. Do not sweat the deep option questions on this test. Understand the basics. Okay. Okay, so now we're going down to, Joe, again, the wording, you have to take your time and worry about, you have to try to figure out what they're asking. Are they asking you, for cost basis? Are they asking you, what does a person want? You have to take your time and read the question. So what I do sometimes is I tell people, read the question, read all four choices, and then read the question again. And then try to answer it, because sometimes seeing the four choices will help you figure out what they're asking. The thing is, Kaplan, STC, Past Perfect. I'm not a big fan of the Walker book. I know somebody liked it. I think he's too busy about trying to make jokes and stuff like that and trying to make it funny without doing stuff. It's okay. You could probably pass the SIE, but I think you'll have a tough time with the top off, whatever top off you take. So STC, Past Perfect, Notman is really selling Kaplan books, and Past Perfect. They're all pretty good. Outside of that, and Training Consultants is pretty good. Another version is Securities Institute of America, or under Wiley. It's a cheaper version, very basic. You can pass with it. It's not my favorite, but again, if you're paying for it yourself, maybe that's the way to go. Okay. Now, somebody said, is there an easy way to remember which regulator regulates what? Okay. So FRB technically it's a regulator, but it isn't. I don't think of it that way. Think of this. SEC is the big dog. They're the government. They regulate anything to do with securities, whether it's options, whether it's, they kind of do options, but options, whether it's equities, bonds, anything that's a security, they control. They are the government regulator. Then what they do is they farm out who controls what. The Chicago Board of Options covers options. FINRA does equities and bonds. They don't actually regulate the securities. FINRA regulates the broker-dealers, the agents, and the exchanges. They do not regulate stocks. They don't do it. SEC does the stocks. And then the exchanges may make some rules on that. But again, the exchanges are under FINRA. MSRB, that's, again, they're not a regulator. So there's just like 12 people in a room. They write a bunch of rules, and then they let FINRA and the SEC and the Federal Reserve Board regulate. So MSRB writes rules. Let's go back. SEC is a government. They cover all securities. The Federal Reserve Board is all about banks and any money between Reg T, any money between broker-dealers and customers. MSRB controls all banks, dealers, and agents who are selling munis. They do not regulate the actual issuers of munis, because the issuers of munis are states, which are exempt. They don't follow the rules. They don't have, I mean, think about this. What can you do now in 33 states that's against federal law? Smoke weed. That's a federal law. You're not allowed to smoke it, but in the states have allowed it. So they don't have to follow federal law. So states do not follow MSRB. Again, it's to regulate the banks and the broker-dealers and the agents who sell munis. But they write the rules, and then the SEC, FINRA, and the Federal Reserve Board regulates them. Okay. Let's try this one. Anna asked a question. An investor with no other position sells 4 June 45 calls at 4. The calls are exercised when the stock is trading at 47 1/4. What's the profit and loss? So first of all, when they do profit loss, you'll deal with the 4 later, but I don't look at how many I did first. I figure out the break even. So always remember, if it's a call by itself, buy or sell, it doesn't matter. You add to the strike price. 45 plus 4 is 49. If it's a put, I subtract. So my break even is $49. Now the call is exercised and stock is trading at 47 and a quarter. Now remember what I said before. If you sell a call, you have the right to sell at a strike price. Not the right, you have the obligation. Sorry, it's late. You have the obligation to sell at 45. So if you exercise, you're going to sell the stock at 45, but you do have $4 in your pocket from selling the option. So you really sold at 49, which is your break even. So if you sold at 49 and then bought it back at 47 and a quarter, if they didn't say that, but it should be, the stock's trading at 47 and a quarter. What's the difference there? $1.75. I'm horrible at math. So say it's $1.75 times 4. So what's 175 times 4? I can't do that. 175 times 4. That's, I think that's $700. So the point is it's a $700 because first it's bearish because you sold the call. In reality, you sold the stock at 49. It's at 47 and a quarter. You sold it at 49, which is 45 plus 4, which is 49. You bought at 47 and a quarter. The difference is your gain. If it went over your break even, then it's a loss. So remember that break even means you're neither making money or losing money. So half the battle is if you can get the numbers, profit and loss. So let's do this. Stock's trading at, say you have a break even of 49 and it's selling a call. Anything below 49 is a gain. Anything above 49 is a loss. If it's bullish, say you buy a call, anything above 49 is a gain. Anything below 49 is a loss. Okay. Okay. We got that. Okay, so yeah, Joe, don't worry about the options. You're going to get one. You're almost better off just mailing it in and just understanding the basics. Don't overthink the options. Okay, don't, again, the next exam you can, not this one. Okay. How do you hedge against inflation regarding blue chip companies? Okay, so here's the thing. We all know what inflation is. Inflation is the rising cost of goods. Okay, the rising cost of goods. So, you know, shoes you bought 2 years ago were $100. The same shoes now are 105. So prices go up. The best hedge against inflation is common stock. Best, bar none. Best hedge against inflation is common stock. Because common stock, they move up around 10% a year. It's not a flash in the pan. Since 1926, they've been going up 10% a year. Inflation goes up around 2%. So if goods you bought at $100, after 2 years are like 104. But if you bought a common stock for $100, after 2 years, it's about $122. So you make more on the stock than you would on the product. So the stocks will move faster than that. I think I'm losing people. I think I'm pissing them off somehow. Okay. So let's see. The next one is, we got that. If humble answering the questions. My test is tomorrow. Any tips? Second try. What do you look for? First of all, tonight, depending who you look at, if you have Notman, read their class summary. If you have SDC, memorize those crunch time facts. Wow, I'm really losing people. I'm really doing something wrong here. So just make sure you focus on the customer counts and regs. That's big. Okay. Now, the next one. Why are REITs not part of DPPs? They are totally separate things. A DPP is a limited partnership that you, so say I wanted to start a company and I'm the general partner. I want to run it. So I have all the risk. I want to bring in passive owners, people who I don't have to listen to. So I'm going to bring in limited partnerships. That's a DPP. Now, the thing is about a partnership is all the money I make. So if I make 10 grand and I have 2 partners, I will make 10 grand and I will get 3,300 and each of them will get 33. Yeah, I'm missing $100, but I get a third, they get a third, and the other person gets a third. So that passes through the gains, but it costs me money to do this. So maybe it costs me $2,000, or to make it easy, they say it costs me $900 to make this money. I give that every owner will get a little piece of paper worth a third of my losses. So they make $3,300, and then they get a piece of paper say that it costs them $300 to do this. So what happens is they have $3,300 gain, but they have a $200 loss that they don't have to pay for. It's just a write-off that they can use to lower what they pay in taxes. Limited partnership pass through both gains and losses. When they mean pass through losses, it means they get a write-off. Like if you do your taxes and you get to write off the fact that you say you make 50 grand a year and you donated 5,000 to charity. That's a write-off. That's a loss. You can lower your income by 5,000. So then you're only making 45,000 and you pay taxes on that. I hope that helps a little bit. A REIT doesn't get that. A REIT is like a stock. They don't pay. So basically what happens is a REIT is you buy shares of it, just like a stock. You can short it, buy it on margin, all that. They pass through 90% of their income. They don't pass through all, but they pass through none of the losses. You get no write-offs if you own a REIT. It's like if you own shares of IBM, you're not getting a write-off. You're just going to pay you dividends if they want to. Where in a REIT, they have to pay you dividends. They have to pay you the 90%, and they pay it in dividends. I hope that helps a little bit. Okay. Okay. Knowledge of capital markets. Yeah, that's like the first chapter. That's okay. Okay, let's see what else we got. I'm glad everyone's helping each other. Okay, so when I always think a call up, put down for break evens, right? So if I have a call, it's always, if it's by itself. If you buy or sell a call, it doesn't matter. It's strike plus premium. If it's a put, it's always strike minus premium. Always. Okay. Now, a customer buys one ABC Gen 35 put for premium of 3 and simultaneously buys 100 shares for 35. What's a break even? Okay. So here's what I tell everyone. It's a little trick. Whenever you have stock and an option, it's always stock plus or minus premium. Stock plus or minus premium, not strike. So again, stock. So we have stock here and we have the premium. We either add or subtract. And the way I remember for this, for the SIE, for the real option trading, it's not as effective, but on the exams it is. If you see two buys or two sells, you add. If you see a buy and a sell, you subtract. Okay? So if I buy, in this example, buys an ABC Gen 35 put at 3 and simultaneously buys shares at 35. So I bought stock at 35 and I bought a put at 3. So I go 35 plus 3, 38. If I bought shares at 35 and sold a call, that's a buy and a sell, so it'll be 35 minus. I hope that helps. So always remember if it's the same. Now, inflation was increasing money supply, sort of is, but what happens when there's more money in the economy? People buy things. And what happens? Prices go up. So inflation is because of an increase in the money supply. So if there's more money, people buy, prices go up, that's inflation. Okay. Fund of funds, I hate them. A fund of funds, somebody asked fund of funds and suitability. First of all, fund of funds is a fund of hedge funds. So it's a mutual fund that buys hedge funds. Since to buy a hedge fund, you need to be accredited and you have to have money and you have to be willing to take risk and sophisticated. But if you buy a mutual fund that owns hedge funds, then you can be a regular retail grandma can buy that. I pick on grandma a lot, but grandma is the one who can buy mutual funds. So if she really wants to buy a hedge fund, she can buy a mutual fund, and what this mutual fund is buying multiple. Okay. Now, the problem with this is that it's not really suitable for a lot of people because the fees are high. Remember, hedge funds charge like 2% and 20% of the gains, and then the hedge fund charges. Okay. Hedge funds charge fees and the mutual fund charges fees. So you're paying double fees. I freaking hate them. Okay. Yes, Mike. If you buy or sell a call, you add to the premium by itself. If you buy or sell a put, it's down every time. If they're alone, if they're with a stock, then you do what I said. 2 buys or 2 sells, you add to the stock. The buy and a sell, you subtract. Okay. Ace P. I don't know who you are. That's funny. Thanks. I'm happy to help. I'm just trying to help people out. Look, I'm a full-time tutor and a compliance officer, so I make money. I tutor, but I do have a lot of students and I make a lot of money doing this. So I kind of want to give back to some people because I know not everyone can afford my $150 an hour. So I try to help people out. Okay. I think that's all. Did I miss any questions? I tried to answer all of them. I think that's pretty good. Percentages we need to know. Well, do you know how to do current yield? So let's do this one. So if I have a bond, oh, Mike, we can talk about that in a second. So that's a tough one. But if you have current yield, current yield is going to be, let me do it this way. So let's say you have a bond trading at 1200. It's a 4% bond trading at 1200. What's your current yield? So let's do it. So current yield is coupon over market price. Or if it's a stock, it's the annual dividend over the market price. So if I have a 5% bond trading at 1200, I'm going to do 50 over 1200. What do I get? I'm thinking everyone's going to bed. Hold on. I know it's late, and some guy said he couldn't do Wednesday nights, but this is the only night I'm not teaching every night. So it's coupon or nominal. You can use nominal. That's fine. So 50 over 1200 is 4.1%. And always remember, okay. So the whole point is it's always what you're earning over what you spent. Yep, you got that, 4.16. So if you have a premium bond, the yield will always be lower than the coupon. If you have a discount bond, the yield will always be higher than the coupon. Always. Every time. And maybe you need it for this exam, but it goes like this. If it's a discount bond, it goes coupon, current, yield to maturity, yield to call, low to high. If it's a premium, coupon, current, yield to maturity, yield to call. Okay. So Joe, what I mean by Finra rules, you got to look in the Kaplan book. I don't have the Kaplan book, but there should be a thing on customer counts or regulations. I don't have the Kaplan book. You never have to do the formula for yield to maturity, ever, ever, ever. You need to know the relationship. Okay? Current yield you have to know. Coupon divided by the market price. Again, 5% bond, trading at 1200, you're going to do 50 over 1200. That's your current yield. You got to, for Fin rules, I don't know where that is in the Kaplan book. I know in STC it's 14 through 18. And I don't know. I'll try to look it and put it as a comment on this at some point. Okay. Again, current yield, you got to know that it's going to be 3 or 4. And again, how about this? If I have a stock that's trading at $75 and it pays a 75-cent quarterly dividend, what's my current yield? And Jordan, I'll work on that. So actually, if I have, I don't even know what I said. So I have a 75-cent dividend, quarterly dividend, and the stock's trading at 75. What's my current yield? So first you have to find the annual dividend, which is 75 cents times 4. So that's $3. Then you divide that number by the market price, which is 75. So 3 divided by 75 is 4. Okay, Jordan, I'm going to help you with that. Yeah, good, Mike. I am going to help you with that tax bracket question. It's not in this exam. Yeah, everyone misses that quarterly thing. But remember, always think if they're doing a dividend, they're going to show it quarterly, 9 times out of 10. So Jordan said, I'm in the 24% tax bracket, and I have a 7.5% bond. So here's the question. Is it a corporate or muni? You have to know. If it's a corporate bond, you're going to multiply by 100 minus the tax bracket. If it's a muni, you're going to divide by that number. So the after-tax yield would tell me that he's talking about a corporate. So I would do 7.5 times, hold on, let's do this, 100 minus 24. That gives me 76. So I'm going to do 7.5 times 0.76. That gives me 5.7. So again, we're looking for the tax bracket. You're in the tax bracket. We took it for the after-tax yield, or the tax-free equivalent, I guess they call it. So I'm going to take the 7.5% bond, which is entered as S in the question. Yeah, it's not going to be on this one. It'll be on the. It'll be on the. This will be on the top offs, not the SIE. So you have a 7.5% bond, and you're in the 24% tax bracket, which means you're bringing home 76%. So you do 7.5 times 0.76. That gives me 5.7. So that's what I will get after taxes on a corporate. Now, if they give you a muni, you just divide. So if you had a 7.5% muni and they want to know the taxable equivalent, you would do 7.5 divided by 0.76, and you get 9.8. That's the other way. That's the way they ask it more than anything else. Okay. Somebody said something. Okay. So Mike G, getting sponsored is a little tough because you got to find a firm that'll help you. So what you do is you reach out to like Edward Jones or A.G. Edwards. I know they sound the same. Or like a Northwestern or Primerica. A lot of them are going to want you to eat what you kill kind of jobs. Or you can start going on Broker Hunter. I think that's a website with a lot of stuff. They've relaxed the rules that it used to be that you had to actually be selling to investors to have to take the 7. Since the switch, they've made it very easy that anyone who works for a broker-dealer, they're more than willing to register, or at least be registered, whether the firm will let you do it or not. So again, if you really want to get sponsored, you look for Edward Jones, A.G. Edwards, Morgan Stanley, Merrill Lynch. They all have like these financial advisor programs. They're tough. It's a tough uphill battle on these things because who wants to give a new person money? But they can pay. Primerica, Northwestern, and some of the, like AXA won't pay you unless you bring in business. But the other ones can pay you a salary. But they also expect you to get these tests done and hit benchmarks. Or you can go on actually the websites of the firms and start applying. But again, check out Broker Hunter. I think Citigroup uses them a lot. The 57 is not useless. It's if you want to be a trader, so then you can work for one of these prop trading firms. That's what you need the 57. Look, if you can get the 7, get the 7. But if you're going to be a trader, you still need the 57. He's asking if the 57 is useless. It helps you if you're going to be an equity trader. Okay. Yeah. Again, right. All these financial programs, they'll pay you, but they expect you to follow rules and take the test within like 2 weeks and 2 weeks and 2 weeks. So you're better off going into getting into what do you call it? Into a program after you've done the SIE. Okay, so the 6 and 63. Okay, the 6. Okay, is not horrible. Okay, it's the same thing. It's about suitability, but remember, you're only worrying about mutual funds and annuities and some insurance for the most part. So the 6 is going to be easier than the top off 7, but it's still remember it's about suitability. Okay. Now, the 63 is state rules. Here's the thing about the 63. It's not that hard if you do the work. Now, if you do the work and you read a lot of accept questions, exempts, and stuff like that, but don't sweat it too much. If you give yourself a good 2 weeks or a week and a half, you should have no problem with the 63, as long as you focus on reading. Again, if you guys need help and you live in the city or on Skype, I'm glad to help you. That's not free. This is, but we'll go from there. Mike, you said about compromise with creditors. If that's on like somebody coming in with a compromise, it's a disclosable event. It's not going to stop you from working. It's just if that happened with you, you just have to disclose it. And since 2008, a lot of people have that. Like, if this was 2004, I'd be like, it'd be tough getting a job. But now after the mortgage crisis, it's pretty much a lot of people do it. They're not going to worry about that, especially if it happened a few years ago. Okay. Yes, you have to disclose on your U4 form. Okay, a broker-dealer Have to be registered in the state as well as the rep. Yeah, the rep can't be registered unless the BD is. So if you want to be working for, if you want to work in a state, your broker dealer has to be registered. There's some exemptions, like if you have only institutions and no office, you don't have to register. But if you want to work in a state, pretty much the rep has to be registered, and this broker dealer has to be in the state so that the rep can register. You can never be registered without the broker dealer being in there. Okay, I got about 3 minutes before I have to head out and catch my train. Before my wife, who just texted me asking when I'm going to get home, and go from there. Any last minute questions? If not, I'm going to do this every Wednesday. See how long it goes, and I'm trying to build up a little bit of a brand so I can do stuff. So please, if you guys work in a big class, tell them every Wednesday I'm doing this. I'm happy to do this, and if I get a lot of people, I'll do it longer. And you all have a good night and good luck. Anyone who's taking it this week, feel free to email me. Check out my website, see if I can help you. Thank you, and have a good night, guys. I'll repost this so you can hear my ramblings at a better time. Yeah, you can leave questions, but let's see what I don't know if I'll remember them because I am a flake. But let's see what happens. Hey, have a good night, guys. Bye-bye. I'm heading out. If I knew how to close it, I would. Yeah, check my email. It's on my I think the link is in my oh yeah, I'll try to handle that. So yeah, I can't leave. So my email should be somewhere on my channel. Have a good night, guys, and I'll see you Wednesday. And if you're taking the test before then, I hope I don't see you in the nicest way possible. Good night.